Howdy and welcome, everybody. It's the weekly economic update for January 3rd, 2022. Thank goodness it's a brand new year. I think most of us are pretty tired of the last 2 years. It's been pretty terrible, especially if you like to go out and about and not have jackasses give you a hard time about wearing face diapers or whether or not you've had some ridiculous shot. But I hope everyone had a good New Year's weekend. I imagine some people are probably taking the day off since New Year's Day was over the weekend, and I was out and about this afternoon. That's why this is a little late. The wife and I went and had some lunch, and went and picked up the mail at my office and did some other things. And it looks like a lot of people were pretty much taking the day off, so must be nice. But like I said, hope everybody had a great weekend. If it's your first time watching, please click the little subscribe button and the like button, and be sure to follow along. And if you have any questions or comments, don't hesitate to shoot me an email. See my email address right there, r.dahlman@DSA Financial Group. All righty, well, let's go ahead and jump into what is going on in the world this week. All right, the week on Wall Street. Stocks closed out the year on a mostly positive note, adding to the year's gains as concerns about the economic issues of Omicron infections receded. The Dow Jones rose 1.08, the S&P was up 0.85, NASDAQ was flat at negative 0.05, and the international was up 0.80. So if you remember last Friday, I went through all the different asset classes. It looks like, the domestic, large, small, and mid cap had a really good 2022. International, not so much. I think probably the highest return was, 8 or 9% in the international space. So, and then the bond market was, not very good. And then also precious metals and other commodities were the laggards last year. So, based on everything that I'm looking at, I would imagine that, and even some of the things I've read to you over the past few weeks is that, the expectation is that international will probably have a stronger year than domestics with the inflation that we've seen. Probably, it is, guesstimated that, gold and silver and other commodities will have a much stronger year this year with the inflation that we're seeing. So we'll see, it's too early to tell. Obviously, we're only the first business day into the year, but I'll stay on top of where things are trending, and don't hesitate to ask a question if you have one. All right, stocks notched record highs. The end of the year is historically a strong period for stocks, a seasonal pattern dubbed the Santa Claus rally. This year's final week of trading did not disappoint as stocks posted healthy gains to kick off the week, despite a global increase in Omicron infections. Investors were buoyed by data that showed fewer associated hospitalizations, which helped ease fears of the variant's economic impact. The S&P 500 set multiple fresh record highs, with Wednesday's new high representing the 70th such high in 2021, while the Dow Industrial recorded its first new record high since November. Stocks drifted on lower trading volume in the final 2 trading days of the year, capping a good week, a solid month, and a strong year for investors. So, like I said, strong is relative depending upon your asset mix. I've been playing it fairly conservative and careful the last year and a half since things started to fall apart. So, it really does depend on, if you're 100% in the S&P 500, probably had a great year. If you're 100% in gold, you were down. So it was, it really depends upon the mix. Robust holiday sales. The market got off to a good start last week, in part due to strong holiday sales report. A major credit card issuer reported that consumer holiday spending rose 8.5% from last year's levels, driven by an 11% gain in online sales. It was the biggest annual increase in 17 years. The spending by consumers exceeded pre-pandemic sales by 10.7%. The retail categories that experienced the highest sales increases were apparel at 47.3%, jewelry at 32%. It was particularly robust numbers in view of investor concerns about supply chain disruptions, port congestion, labor shortages, and wavering consumer confidence. All right. So this week, economic data is coming out. Tomorrow we have the job openings and turnover survey, the JOLTS report, the Institute for Supply Management, Manufacturing Purchase Managers Index. Those are the three that are coming out this week on Tuesday. Thursday we have jobless claims, factory orders, Institute for Supply Management, non-manufacturing purchase managers index, and Friday the employment situation. Just a few companies reporting earnings this week. On Thursday, there's Constellation Brands, Walgreens, and Conagra. All right, so that looks like everything for the weekly update. I do have one white paper going out. It's pretty brief. It's titled Outlook for 2022. So let's go ahead and jump into that. By any measure, 2021 was a strong year for investors, but what's in store for 2022? From my perspective, I expect many of the same forces that influenced markets last year will play a role again in the year ahead. COVID-19 remains tragic and unpredictable. The pandemic is one of the primary drivers of financial market activity in 2021. I hope that worst is behind us, but I would not be surprised if to see COVID-related influence or events influence the markets in the new year. The Federal Reserve will continue to get its share of headlines from Fed Chairs Powell's nomination hearings to potential changes in interest rates. Expect investors' attention to shift from the Fed time to time in 2022. Tax laws changes are always possible, but many of the anticipated federal tax law changes in 2021 were linked to President Biden's Build Back Better plan, which ended the year in debate with Congress. So stay tuned. Let's hope it doesn't go anywhere because it is a big steaming pile of trash. Their definition of infrastructure has nothing to do with what I would call infrastructure. All right. So first article I want to read is from First Trust, Brian Westbury, their chief economist. It's titled, Welcome to 2022, The Winds of Change. All right. Welcome to 2022. We can't imagine a more transformative year for America. After 2 years of unprecedented government actions, the winds of change are blowing hard. The economy has been buffeted by short-term factors since 2020. This year, long-term fundamentals should reassert themselves as the most important drivers of economic and financial performance. First, the obvious, COVID and COVID-related rules should have much less influence on our lives 12 months from now than they do today. Seems like everyone knows someone who is tested positive, vaccinated or not. Cases are at record highs, but hospitalizations and deaths are not. So that is good news. See, I have a trick on how you don't test positive for COVID. You never go get tested. That's how I've never gotten tested or never tested positive. Second, and I've never been sick. So that probably has something else to do with it. If I was sick, I would go to a doctor and get a test. But if I'm not sick, I'm just going to go about my life. That's just the way life is. All right. Number two, second, President Biden's Build Back Better plan to increase entitlements and taxes seems mired in the DC muck. Thank God. It's still possible that a plan totaling something like $1.5 trillion or more gets passed. But we think it's unlikely. More likely, either nothing at all or a much smaller bill. Put yourself in the shoes of a relatively moderate Democrats in Congress. Being forced to vote on tax hikes in an election year is difficult, and reluctance is going to grow every week as 2022 unfolds. Third, the midterm elections in November could dramatically limit the ability of the Biden administration to get much done in 2023 and 24, given the history of midterm elections, as well as the election returns in 2021, gubernatorial and state legislative races in New Jersey, Virginia, as well as some races elsewhere. The most likely possibilities seem either a GOP wave or a GOP tsunami. Either would mean no more tax hikes, and the legislation would have to be bipartisan to pass, which should mean a lots of gridlock. So personally, I think the Republic is going to fall apart, and we're never going to have to deal with this crap again. That is my hope. Now I do hope that we go after these bastards in Washington and, have some trials and maybe some draconian punishments. I'd volunteer to be in charge of that just because I'm a mean son of a bitch. Fourth, look for an economic contest between waning fiscal stimulus packages, rising employment, and healing supply chains. The excess demand from massive government spending will decline in 2022, while supply chains appear to be healing. Business inventories are finally rising again. They need to do so after falling dramatically in 2020 and earlier in 2021. And it's hard to imagine chip makers not ramping up production to meet enormous demand. Fifth, the Federal Reserve has its work cut out for it. Its most recent dot plot suggests 3 rate hikes this year, 25 basis points each, and the futures market for federal funds agrees. The big question is whether Fed policymakers have the guts. I doubt it. These people are giant pansies. Given that the Biden administration is trying to pack the Fed with its mini doves that it can appoint, we'd take the under and think the Feds will probably raise rates only twice this year. Sixth, it's important to watch profits. We are all at an all-time high, which are at an all-time high. Remember, some of the strength in corporate results of late is due to temporary and artificial government spending blowouts. Yeah, I remember the $4 or $5 trillion that were printed in the last year and a half. I haven't forgotten about that. Meanwhile, more jobs, lower unemployment, and lower participation could mean higher wages, take a slice out of corporate earnings. We will still expect profit growth of 10% or more in 2022, but this will be well below what we saw in 2021. And last, of course, are the wild cards. Will China invade Taiwan? Will Russia invade Ukraine? We think the former is very unlikely, and with the possible exception of some tiny uninhabited islands off the coast of Taiwan, the latter, if your name isn't Vladimir Putin, you don't know the answer. Either of these could cause temporary sell-off, but neither would change the fundamentals. The winds of change are still tailwinds. So definitely some interesting information there as far as what in Brian's estimation are the the 6 big things that we should really worry about, or at least keep an eye on. Like I said, I have very little hope for the Republic at this point. The best thing that could ever happen is for it to just collapse and let the wokies go live their lives, and they can tax the hell out of themselves, and the rest of us can just live our own lives and ignore them. I think that's probably the best way. Or we're going to have to deport them. So, one way or another. All right. Next article is Fed drains 1.9 trillion in liquidity from market via overnight reverse repos. I know I probably talked about this a couple of times over the last year plus. The reverse repo market is where the Fed and the banks basically shuffle money back and forth overnight so that their books balance. And so we're going to go read through this because the amount of money changing hands has reached all-time high levels. This was written by Wolf Richter for Wolf Street. The New York Fed disclosed today that its overnight reverse repos spiked by 208 billion from yesterday to a record of 1.904 trillion. With these RRPs, the Fed took in 1.9 trillion in cash from 103 counterparties and in exchange handed out Treasury securities, temporarily draining 1.9 trillion in liquidity from the market and financial system. The RRPs mature on Monday, January 3rd, which is today, when the Fed gets its securities back and counterparties get their cash back. They'll engage in another round of RRPs. Then they'll engage in another round of reverse repos. Today's RRPs replaced 1.7 trillion in RRPs from yesterday. That matured and were unwound this morning. So you can see here by this chart from first quarter of 2021 and second quarter, third quarter, fourth quarter. And I mean, we did have this bump here in 2020. And I know this was making big news back at the end of 2019. So this is quite worrisome. I mean, I don't know how far this can go before it really causes major problems. But, I'm bringing it to your attention, something for you to, keep an eye on. A few weeks ago, I posted in the illustrious Wolf Street comments that RRPs would spike at the end of December, maybe to somewhere near 2 trillion as banks engage in quarterly balance sheet window dressing. A spike today was expected for that reason, as with some prior end of quarter spikes labeled in the chart. RRPs are opposite of repos and qualitative easing. With repos and qualitative easing, the Fed hands out cash and takes in securities in order to repress interest rates. With RRPs, the Fed takes in cash and hands out Treasury securities in order to put a floor under short-term interest rates. The counterparties with too much cash. Counterparties are financial institutions that are creaking under excess liquidity that the Fed has created with its monstrous quantitative easing. And this cash was showing up in the money market, or showing up in money market funds. The funds then needed to invest this flood of cash in short-term treasuries, such as treasury bills. This flood of buying caused short-term treasury yields to turn negative. That's when the Fed offered to take this cash via RRPs when it offered to pay interest at an annual rate of 0.05. Cash came gushing into the Fed's direction, and Treasury yields bounced back above 0%. The approved RRP counterparties fall into three groups: money market funds, banks, and government-sponsored enterprises, such as Fannie Mae, Freddie Mac, and Farmer Mac. Day-to-day, money market funds have been the biggest users of the reverse repo facility. The Fed raised the limit per counterparty to $160 billion to accommodate the needs of the biggest money market funds. Big financial institutions such as Fidelity, Vanguard, or BlackRock manages numerous money market funds, but each individual money market fund is a counterparty of the New York Fed. Of Fidelity's money market funds, 11 are approved counterparties with the New York Fed. All combined have been the largest user of the RRP facility. The Fed doesn't disclose on a daily basis the participants, but end-of-month data is released with a lag. At the end of November, all of Fidelity's money market funds combined had $288 billion in RRPs with the Fed, or 19% of total RRPs at the time. Vanguard's money market funds combined, the second largest user of the facility at the end of November, had a balance of $165 billion, or 11% of the total RRPs. BlackRock's money market funds had a combined balance of $155 billion, or 10% of the total RRPs. JP Morgan's 5 approved money market funds combined were in fourth position with $134 billion. Here are the top 9 counterparties as of November 30th. And it shows Fidelity, Federated, Vanguard, JP Morgan, Morgan Stanley, Northern Trust, BlackRock, Goldman Sachs, and Dreyfus. And you can see the lowest one is around 70 billion. So anywhere from 70 billion up to just under 300 billion, which is Fidelity. But today, quarter end window dressing by the banks. On the last business day of the quarter, banks pile into RRPs to shed cash from their balance sheets and replace it with Treasuries securities for a day. The balances at the close of business today will make up the balance sheet for the Q4 and year end. These window dressing spikes are visible in the first chart. That $208 billion spike from yesterday's RRP balance was likely due to banks' balance sheet window dressing. Banks want to reduce cash balances and increase Treasury securities on the balance sheet at quarter end for regulatory reasons. Banks can deposit their cash at the Fed directly and earn more in interest than with RRPs. On the Fed's balance sheet, these deposits from banks are liabilities that the Fed calls reserves, and it pays interest on them at an annual rate of 0.15%, which is more than the 0.05% it pays on RRPs. But on the bank's balance sheets, these reserves are still called cash, such as interest earning cash or similar, and for regulatory purposes still count as cash. Normally, banks put their excess cash on deposit at the Fed and earn more in interest than they would in RRPs. But for just one day at the end of the quarter, when banks want to reduce their cash holdings and replace them with Treasury securities, they engage in this window dressing exercise via RRPs. On Monday morning, those window dressing RRPs will unwind, and the overall balance will drop back down to near where it been over the past few days. Way too much liquidity due to QE. The real issue is a monstrous amount of QE since March of 2020. These RRPs show that the Fed could reduce its balance sheet by $1.9 trillion. It would just mop up the excess cash now absorbed by the RRPs. Long-term interest rates would rise as they should rise, given that there's nearly 7% CPI inflation currently, and most in 40 years. While back then, interest rates were far above the rate of inflation, but in terms of liquidity, reducing its balance sheets by $1.9 trillion would remove the excess liquidity that it has now been absorbed by the RRPs. So definitely some interesting little bit here. So, and then the last article I wanted to touch on, I saw this over the weekend, and it's a little worrisome. The title is, this comes from the Center Square. Title is Indiana Life Insurance CEO says deaths are up 40% among people ages 18 to 64. So basically working age. All right. The head of Indianapolis-based insurance company One America said that the death rate is up a stunning 40% from pre-pandemic levels among working age people. We are seeing right now the highest death rates we have seen in the history of the business, not just at One America. The company's CEO, Scott Davison, said during an online news conference this week, the data is consistent across every player in that business. One America is a $100 billion insurance company that has its headquarters in Indianapolis since 1877. The company has approximately 2,400 employees and sells life insurance, including group life insurance to employers in the state. Davidson said the increase in deaths represents huge numbers. That is not that it's not elderly people who are dying, but primarily working age people 18 to 64 who are the employees of companies that have group life insurance plans through One America. And what we saw in the third quarter, we're seeing continue in the fourth quarter, is that death rates are up 40% over what they were pre-pandemic. Just to give an idea of how bad it is, a 3 sigma or a 1 in 200 year catastrophe would be a 10% increase over pre-pandemic, he said. So 40% is just unheard of. Davidson was one of several business leaders who spoke during the virtual news conference on December 30th that was organized by the Indiana Chamber of Commerce. Most of the claims for deaths being filed were not classified as COVID-19 deaths, Davidson says. What the data is showing is that the deaths are being reported as COVID deaths greatly underestimate the actual death losses among working age people from the pandemic. It may not all be COVID on their death certificate, but deaths are up huge, are just huge numbers. He said at the same time, the company is seeing an uptick in disability claims, saying that it was short-term saying at first it was short-term disability claims, and now the increase in long-term disability claims. For One America, we expect the costs of this are going to be well over $100 million, and this is our smallest business, so it's having a huge impact on that. He said the cost will be passed on to employers purchasing group life insurance policies who will have to pay higher premiums. The CDC weekly death counts, which reflect the information on the death certificates, and so have a lag of up to 8 weeks or longer, show that the week ending for November 6th, there were far fewer deaths from COVID-19 in Indiana compared to a year ago, 195 versus 336. But deaths from other causes, 1,350 versus 1,390. These deaths were for all ages, for people all ages. However, while the information referenced by Davidson was in working age people who are employees of businesses with group life insurance policies. At the same time, at the same news conference where Davidson spoke, Brian Tabor, the president of the Indiana Hospital Association, said that hospitals across the state are being flooded with patients with many different conditions, saying, unfortunately, the average Hoosier's health has declined during the pandemic. In a follow-up call, he said he did not have a breakdown showing why so many people in the state are being hospitalized for what conditions or ailments, but he said that the extraordinarily high death rate quoted by Davidson matched what hospitals in the state are seeing. What is confirmed for me is bore out of what we are seeing on the front end, he said. The number of hospitalizations in the state is now higher than before COVID-19 vaccine was introduced a year ago, and in fact is higher than it has been in the past 5 years. Dr. Lindsay Weaver, Indiana's chief medical officer, said at a news conference with Governor Eric Holcomb on Wednesday. Just 8.9% of ICU beds available in the state. Yeah, they're just getting into some minutia here. So, like I said, this is a bit concerning that deaths for just your average person who's 18 to 64, which odds are those are probably your more healthy people. You're not 85 years old and at the end of your life, if you're say 50 years old, I mean, odds are you should probably, you should be in good health. Unfortunately, if you go out and walk around America, you see that, somewhere between 60 and 70% of our fellow Americans are either obese or overweight. So it's actually not shocking. Let me just stop that. But it is a surprise that there has been a spike in mortality. So, all right. Well, that's everything that I had. I only managed to ramble on for 24 minutes. So, hey, I'm off to a great start for 2022. All right. Well, that's everything I have for today. So if anyone needs anything from me, don't hesitate to reach out or drop me a phone call. I will be back tomorrow with the Liberty Call and some new articles. I'm sure I'll dig some more stuff up as I'm reading tonight. And everyone have a fantastic evening. Bye-bye.